Hi, this is Mark Item with HONU Trading for the weekly review, May 15th, 2023. As always, education only. Know your time frame and risk tolerance. Risk management is job one. You can follow me on Twitter at HONU Management, HONU MGMT. And if you find this valuable, take a moment to like and subscribe. So today's agenda. Hat tip again to Chris at Deja-Vu Capital for the quote of the week. If the Fed is going to cut, bad things must happen. Now let's spend a minute talking about this next bullet point. Bull markets climb a wall of worry, and we have one the size of the Great Wall of China. But the market knows all the bricks in that wall of worry, which is why we can climb it. Inflation, debt ceiling issues, politics, war in Ukraine, all the other things that are going on in the world. The market knows all that. And at best, we haven't collapsed yet. In fact, in the face of all this bad news, I still want to be a bull. A bare minimum, here's another week where we've got the big bear snoozing on the picnic table, soaking up the sun. But it's truly the Yogi Berra market, Deja-Vu all over again. If you thought last week was boring, well, this was even more boring. It was an inside week. Monday, totally flat day. Basically went sideways from the opening, closed right about the same area. Tuesday, small gap down, but the rest of the day, very small range. CPI Wednesday, gap up and then fell. Now that's not a characteristic of bull markets. Bear markets open strong and close weak. But for the first of what will be 3 days in a row, we closed strong. We got an end of the day kick save. So basically unchanged on the day. If you walked away from your computer right after the opening and didn't look until the close, not a big deal. You thought it was another one just like Monday or Tuesday. But there was quite a bit of intraday range. Thursday, PPI, we gapped down and closed right about the same area. Not a hugely strong close, but at least towards the end of the day, a rally. Then on Friday, gap up and fail. That's the second time that happened this week. And when the bears flexed their muscles, the bulls, acted like Lucy and pulled the football away from Charlie Brown. Not the strongest close, but for the entire week, down 0.25%. Breadth has got to pull its weight. The good news, this week we were down 364 net new lows. While that's not great, that's less than half of what last week was. During the week, plus 32, minus 55, minus 73, minus 126, minus 142. Now, that trend is not your friend. That's getting worse throughout the week. I've shown this particular graphic for several weeks now. It is the equal weighted relative to the cap weighted. And the S&P, new lows. The QQQ, slight new lows. MDY versus the mid caps versus the big caps, about the same. Really haven't gone anywhere in a month. And the small cappers, that's worse, but it's not wildly worse. For the week, the heat map, Microsoft and Apple, which held the bulls last week, took the week off. It was Google and Amazon that stepped up this week. Now, more on this later when we talk about the banks, but the financial services, I want to highlight this particular segment. The big banks all had red weeks. Visa and MasterCard, they're the second and third largest components of XLF, the financial index, and they basically took the week off. Insurance did well by and large. The data services and the exchanges, those did okay. The brokers had another bad week. Asset management, kind of a mixed bag. So another thing I instituted last week, and again, hat tip to Chris at Deja-Vu Capital. This is the S&P 1500. That's the 500 big cap, the 400 mid cap, and the 600 small cap, all combined into one index, relative to intermediate term treasury bonds. And this is a pretty clear risk off, like we saw in the COVID crash or in the 2022 bear market, or risk on, the second half of 2020 and 2021. But for almost 6-7 months now, we've been stuck in this range where it doesn't know what it wants to do. It's not risk on, it's not risk off, it's What? So it's not really doing anything. And again, the best thing I can say about that is that it's not falling apart in the face of all this bad news. Financials zooming out a little bit this week to a weekly view. Not much change inside, but a slightly down week. This 30 level, still better hold. I've zoomed out. This actually goes back to 2008 as a resistance level for 2018, pre-COVID in 2019 and 20. But resistance, once broken in 2021, tends to be support. And so far it's been tested once, 2, 3 times. Now, we haven't really gone anywhere on the upside, so unless we can get above 34, no real change to the bear case on the financials. Like we looked at in the heat map, the big banks slightly down on the week. Haven't taken out the lows yet, but they haven't gotten above the late March lows. The regional banks, they're still kind of circling the drain here, but they haven't gotten any worse. As far as earnings, we're most of the way through that. I put something up on Twitter earlier this week. Earnings have been down 4% and revenues up about 4%. Now that's sequentially worse than last quarter. Earnings were down 3% and revenues were up a little bit more. But we're through most of that now, and the earnings we have coming up in this week, we get the retailers. Home Depot, TJ Maxx, Target, or as I call them, Target, Walmart, and then 2 other stocks, Baba, not part of the S&P 500, they're Chinese, and then AMAT. So let me introduce a new game on earnings. I'm going to call it Jacked or Whacked, because typically you get some significant moves on earnings, and jacked means something like a COPA, which in one day broke out and was up about 10%. Whacked is something, and I can't resist this, Axon got tasered. Down 15% in one day. And I got to confess, we've seen a lot more whacked than jacked this earnings season. So to sum it all up, if the Fed is going to cut, bad things have to happen. They haven't happened yet. The market knows about all the bricks in the wall of worry, and we still have that tired, worn-out bear. The bad news is still out there, but we haven't gotten any worse. So cautiously bullish, but remains a tough market. As my buddy HONU always says, keep your losers small because small losers win.